There's a lot of different factors at play here. You have the war in Ukraine, you have the growth outlook in China, you have cost pressures that companies are facing. Which one is paramount in your view?
All of them.
Fair enough. If you had to pick one, though.
It's a dangerous stew of stuff, right? And I think because, oh gosh, I hate to trot this out. So I have a math degree, and I had a prior degree as a software engineer, but I did a lot of math in that because it was AI, and that's essentially mathematical modeling. So the markets are mathematical modeling too. So in any kind of season, what you have to understand is the market's going to reflect a handful of items, but it's all of this stuff that's happening in the world goes into it as well. But it's shifting priorities that happen. And as an investor, that's what you have to pay attention to. Yes, some days it's inflation, some days it's earnings, some days it's the Ukraine, but overall it's that, over weeks and months and certainly years, all of it goes into how markets act.
Okay, so when you put all of it together, it's not just about how the markets act, but ultimately what happens to the U.S. economy. Where do you put the odds of recession in, say, the next 18 months to 2 years? Goldman Sachs says 35%.
Sure. Well, I take the under of that. And here's why. Well, I'm an equity analyst and I'm hopeful for the future. So that's my bias. But what the real answer is this. I heard the Bill Dudley comments about a small labor pool. But the fact of the matter is companies are going to deploy technology in as many places as they can to take people out of the equation. And that's not a bad thing. It's going to replace stuff that people don't want to do anyhow, rote kind of activities. And so I think that's not factored in and can't really be factored in. Inflation cannot grow to the trees. It cannot keep growing. Markets work, supply and demand works. When the price raises, it does its job, demand destruction, and it falls back. So you just have to have a longer view of the markets to understand that, these short-term problems in the long run are going to be problems, but not as big as we think they are today.
Okay, but Kim, you mentioned demand destruction there, which brings me to companies' ability to exercise pricing power. I want to point to the research out from Mike Wilson over at Morgan Stanley in the last 24 hours or so. He says margin expectations look overly optimistic for the balance of 2022. Given the myriad of cost pressures companies face, we think the positive effects of inflation on earnings growth have reached their peak and are now more likely to be a headwind to growth. Kim, why are you not more worried about margins here?
Well, again, I'm thinking about demand destruction. I'm thinking about the things people really want, that we think they really want, like EVs and cars. It's unclear that they're going to even be able to get the materials they need to make the batteries. And thus, people are, you can only pay so much up for that car. So I think the demand for products is going to kind of slow down. And I don't know. I can't, the math of it all is just going to work out.
Okay. So finally, Kim, with that view of the world, where do you want to be putting your money?
Well, as I started off here, tech is a great idea. And again, we're going to have Internet of Things. We're going to have companies monitoring many, many things that they can't now. Like, we'll just pick on pipelines. That's a big story this morning about, energy leaks and all that kind of good stuff. But I think the amount of technology that we're going to deploy over the next 10 years is going to make our heads spin. And semiconductors is probably a pretty good place to start for that.